Hi, Charles Sizemore here. So today we're going to talk about one of my all-time favorite dividend stocks, Realty Income. Ticker symbol is O, just the letter O. And this stock is one of the few that actually has a nickname. It's called the Monthly Dividend Company. And that's what they actually write that on their annual report. Like they're proud of this nickname. And now, why would they be called the Monthly Dividend Company? Because they pay their dividends monthly. These guys are one of the very few companies out there that pays their dividend on a monthly calendar as opposed to quarterly. And they've been doing this for quite some time. They've made over 600 consecutive monthly dividend payments over the years. And importantly, about every 3 months, once a quarter, they raise that dividend. They've actually raised that dividend for 94 consecutive quarters and counting. So what do these guys do? What is their business? Why am I so excited about them? The truth is they don't do anything. They're a completely passive landlord. They actually have nothing to do. That is the beauty of a triple net lease structure. In a triple net lease, the landlord owns the building and collects the rent. And that's really where their responsibility stops. The tenant does everything else. The tenant handles the maintenance, they handle the taxes, they handle the insurance. If a toilet breaks at 3 o'clock in the morning, that is the tenant's problem. That is distinctly not the landlord's problem. So why would any tenant agree to that? What's the point? Why would you not just own the building yourself? Well, there's a good reason for that. When you sell the building to a third party like this, to a third party REIT like Realty Income, it does a couple things. One, it creates some tax advantages. When you're paying rent, that's fully deductible. Whereas if you're paying a mortgage, only the interest is deductible. So this has the effect of lowering their taxable income, which of course keeps the investors happy. Now, beyond that, it also makes it a more capital light business, which makes the ratios look better, which also makes the investors happy. So overall, it works. For all intents and purposes, the tenants, run the buildings. They just don't own them. That's where Realty Income comes in. And Realty Income, they're paid for that privilege, of course. Now, where it gets fun, fun may be a subjective term here. I think this is fun, is because this is such a hands-off passive business. There's not a lot of risk. Realty Income tends to focus on companies that are in relatively stodgy, boring businesses that just don't change that much. That they're, for the most part, future-proof. Their biggest, I would say, if you lump them together, pharmacies and convenience stores, which there is a decent bit of overlap there, they together make up about 20% of the portfolio. These are things that are about as future-proof as you're going to get. These high-traffic stores and in areas where there's just a lot of people. You want a gallon of milk, you want the 6-pack beer. These are the kind of the core tenets of Realty Income. Now, the stock price has gotten utterly hammered over the last year, and it's not hard to understand why. When you had when the coronavirus pandemic hit, real estate in general really took a beating. Of course, everyone's lifestyle changed. People went shopping less. A lot of the stores were closed for the better part of the last year, for crying out loud. People went to restaurants less. And that's really where Realty Income kind of, I don't want to say got into trouble, because that implies they actually had some business issues, which they did not. But it's where Wall Street's perception of the company really started to sour. So restaurants make up about 3% of the portfolio, and movie theaters make up about 5.5% of the portfolio. That really spooked Wall Street. And actually, I should add one more. Fitness centers were also a decent part of the portfolio. A little over 6% of the portfolio was in gyms. Now, obviously, these are the things that got battered the most during the pandemic. And Realty Income did have pretty significant exposure. But that doesn't really justify the REIT losing. Well, right now, it's still down by about 25% from its all-time highs. It was down a lot more than that a year ago. This is a clear case of Wall Street overreacting. Now, at today's prices, the stock yields about 4.8%. That may not sound like get-rich-quick money, and it's certainly not. But when you're looking at a world in which bonds still yield nothing, now bond yields have been rising for months now, and they still yield nothing. The 10-year Treasury yields 1.6%. So 1.6% on a bond that you expect to hold for 10 years, that's not really worth owning, honestly. 4.8% in a dividend that I might add rises. You go back to the bonds, bond yields don't, well, yields can rise. The bond interest payments don't rise. So whatever yield you buy that bond at, that's the only return you're going to get if you hold that bond to maturity. There's no payoff down the road where the bond issuer decides to increase the interest payment. It doesn't work like that. What you get when you buy the bond is fixed. It's fixed income. The beauty of Realty Income is that it has a lot of the benefits of fixed income, and that it's a low volatility business and normally a low volatility stock. Now, lately, the stock has had more volatility. I'll go into that later, but it's historically anyway, a low volatility stock that pays off a good bond-like stream of dividends that, unlike bonds, actually rises over time. So over the course of the company's life, this goes back to 1994, they've raised their dividend at a 4.4% compound annual rate. So that's not, again, you're not talking about, .com mania, or, this is not like buying Amazon.com in the mid 90s and enjoying explosive growth like that. It's not like that at all. But you are talking about dividend hikes over multiple decades that have been well in excess of the rate of inflation. And that's the name of the game here. You want something that is bond-like, but not a bond, in that it actually raises its dividend at better than the rate of inflation. Now, I feel very comfortable that it will continue to do that. If we do have inflation rear its ugly head in the years ahead, that could happen. I'm sort of undecided as to where I think inflation goes. My best guess is we do have a pop in inflation this year. I think that dissipates over the coming years, but we'll see. If we do, however, get a big surge of inflation, Realty Income should be just fine. And why is that? Because its tenants generally have inflation clauses in the leases. When you have inflation rising, the rent goes up to match that. So that makes Realty Income a very nice inflation-proof, income play. Now, digging a little bit deeper into the details here, the company owns well over 6,000 properties, and those are divided across about a little over 600 tenants. So you have a lot of diversification there. If you do get a situation down the road where, let's say, the movie theaters have been hanging on, the best they could, but their situation doesn't improve, and you do have some bankruptcies there, that could happen. But Realty Income's tenant base is diversified enough to where they can really withstand something like that. The worst case scenario in my mind is that perhaps, if they really hit the skids here, they might lower the pace of their dividend hikes, or an absolute nightmare scenario, they might not raise the dividend one quarter. I don't expect that. I expect them to keep plugging along just as they have been. For crying out loud, if 2020 didn't kill them, I don't know what will. They continued raising their dividend every quarter throughout 2020. Again, if you can survive that, you can survive the apocalypse pretty much. Now, digging into some of the details here, this is in money and markets, we really like to be technical. We like to quantify our recommendations. We don't like to just say, hey, I like this stock and I had a hunch. And we have a system. Now, where this gets interesting is Realty Income, partly because of its structure as a REIT, and partly because of the events of the last year, it really doesn't rate very well based on our system, based on our green zone rating system. It only rates a 24. But I want to dig into the details here to show you why I think that rating is understated, and why I believe that you're going to see a pretty quick turnaround on that in the years ahead once new data comes in. Remember, our rating system is based on data, which is historical in nature, of course, and recent history is not going to be what the future, well, I should rephrase that. The future is not going to look like what recent history has looked like. So digging into the details, where does it rate highest based on our system? It rates highest on, believe it or not, growth. This is a very boring company. They own pharmacies and gas stations and convenience stores, for crying out loud. This is not an exciting, sexy business. These guys are a boring landlord for boring companies. However, they have been steadily growing for multiple decades now. They snap up these kind of single tenant high traffic properties, and they rinse and repeat. That's been a really nice growth formula for them. The stock rates an 82 based on growth. Now, next up is quality. It rates what would appear to be a very middle of the road 52 based on quality. Now, I think that's dramatically understated for two reasons. One, our quality score is really highly impacted. Well, let me back up again. Our quality score is really designed for operating businesses. And this is not an operating business. This is a passive landlord. Passive landlords tend to have a lot of debt. They tend to finance their properties with loans. That's normal. You and I finance our homes with mortgages. It's the same with REITs. That causes that actually penalizes the company based on quality. Having a high debt load, even if it's for a secured asset like real estate, that penalizes based on our score. Furthermore, REITs tend to have depressed GAAP earnings because they have a lot of depreciation on the properties they own. Even though this is a non-cash expense, depreciation is a phantom expense. It's very useful for lowering your tax bill, but it's not a true expense. Properties tend to increase in value over time, not decrease. But the way the tax code works, you get to take depreciation charges, implying that your property is actually declining in value. It's a stupid law, but we benefit from it. So I have no complaint. But the net result is the standard measures of profitability don't always look good for REITs, and Realty Income is no exception there. So because of that, it gets depressed. Now, the company still rates a respectable middle of the pack 52, even despite the fact that it's penalized in those two areas. If you adjust for that, you would get a far more healthy score here. Moving on, volatility, it rates, after the 2020 experience, it rates again sort of middle of the pack at 46. Now, if we were to run this with pre-2020 numbers, it would not have a volatility rating of 46. That is a product of the pandemic. Now, whenever interest rates in the market get a little bit, whenever we see volatility in the bond market, we often see volatility in Realty Income since it's viewed by many as sort of a bond substitute. But what we saw in 2020 was not that. What we saw in 2020 was investors got scared of all things brick and mortar. They got scared of all things retail oriented, and they just dumped the shares. That caused our volatility score to really take a hit, which is why Realty Income rates a very mediocre 46 on this rating. Give it a few years. I expect that this rating will go back to normal levels. It'll be well into our bullish territory. Moving on, value, it rates a 38 on value. Now, for the same reasons that I would say our our quality score tends to be understated with REITs, I would say it's the same story with value, because you measure a company's value relative to something, and that something is earnings, cash flows, you name it. Well, a lot of the traditional metrics that we used in our value score are penalized by the high depreciation charges. That doesn't affect cash flows, of course, but it affects earnings. And so REITs are perpetually sort of penalized there, and Realty Income is no exception. So I don't consider the stock to be wildly cheap. I think it's very fairly priced right now. Now, if this stock were yielding 7 or 8% instead of 4.8 as it is today, I would be pounding the table with my fist saying this is the cheapest the stock has been in forever. You should mortgage your house to buy it. We're not in a scenario like that. I think at a 4.8% yield, the stock is very reasonably priced, but and certainly better priced than our 38 value score would suggest. But remember, again, our value score is impacted by GAAP earnings and the fact that REITs really shouldn't be using GAAP earnings. the value score, if we were to adjust for that. And I don't really have a good way to adjust for that. That doesn't look like I'm just kind of playing with the numbers. So I would just say subjectively, the value rating should be higher than what is stated. Momentum, this is embarrassing. Momentum, it rates a 9. It rates a 9 out of 100. But again, you can trace that back to 2020. Prior to 2020, this stock had a beautiful chart. It just looked like a wedge. It just goes practically straight up with very few bumps along the road. It was actually a high momentum stock, which is surprising considering how conservative its business model is. Again, let me repeat, this is a company that doesn't actually do anything. It's a passive landlord that owns pharmacies, for crying out loud. But it actually was a really high momentum stock for years. Well, the stock got obliterated in 2020. It's still down 25% from its pre-pandemic highs. So it's very natural that the momentum score took a hit. It's going to take a few years for the momentum score to improve based on, I know the way our model works, and I know that because it looks back several years, this stock is going to have a depressed momentum score for a while. I would encourage you to look past that simply because 2020 is not going to be repeated. We're going to have bear markets in the future, of course. I mean, if there's any constant in the market, it's that there's always going to be a bear market coming at some point. I mean, we can't escape that. But when we do have what I would consider a normal bear market, let me go back. When we've had bear markets in the past, Realty Income takes a hit. Sure, it's a stock. I mean, all stocks take a hit in a bear market, but it tends not to get beaten up nearly as bad as growth stocks, for example. Realty Income tends to be pretty close to recession-proof. There's no such thing as a stock that's bear market proof. Bear markets affect all stocks, but it's certainly recession-proof, and it's what I would call bear market resistant. So the very bad momentum score you see today, that's a product of the pandemic. I do expect that to fade with time. Also, next time we have a bear market, I don't expect it to hit this company nearly as hard. In fact, I would expect investors to run into this stock next time the market gets rocky. And then finally, size. It is a relatively large REIT. It's a multi-billion market cap company, and it rates about a 7 on our size scale. So it's not exactly an undiscovered small cap or anything like that. So again, looking at sort of the big picture on the rating score, you have to know how our system works and know when you should sort of read between the numbers. And this is one of those cases where I really consider this a solid contrarian buy. I don't really consider this a trade though. This is not a stock I would say, hey, buy this, let it rip higher for the next 6 months and then sell it. This is one I would say, look, when it's trading at prices like today's, where it's yielding nearly 5%, you just buy it. You accumulate some shares, you instruct your broker to reinvest those shares. So every time it pays that monthly dividend, it just buys some new shares and you let it run. You let a stock like this run for years or even a few decades, just let this share count continue to rise. When you do get periodic dips, buy a few extra shares. By the time you're actually ready to retire, or if you already are retired, if you want to just give this to your kids or grandkids someday, by the time that event happens, you're going to have a much larger share count paying out more in dividends. I don't know what the yield's going to be a few years from now. I have no idea. But I do know that the actual cash value of the dividends is likely to be a lot bigger. Remember, these guys have raised their dividend every single quarter for 94 consecutive quarters. So I don't know and the pandemic didn't stop that. So I would argue nothing short of nuclear Armageddon will cause this company to materially reduce its dividend. I hope I'm right about that. Fate has a way of challenging these assumptions, but this is a stock that I would be very, very comfortable saying, look, it's one of the few you could buy, hold forever, just forget about, let the dividends compound and be happy. A stock like this can really be a bedrock for your retirement portfolio. So that's all I have for today. We'll pick this up next week.